Every chip powering AI right now, every GPU crunching a large language model, every HBM stack feeding a data center was built using equipment from one company, and most people have never heard of them.
Applied Materials, ticker AMAT. They don't make the chips, but nothing gets made without them.
That's the hook. $281 billion market cap, record demand driven by the AI build-out, and a product pipeline that just dropped 2 brand new systems for the 2-nanometer node. This is episode 84 of Charged Alpha, and today we're going deep on the company that makes the machines that make the future. Let's get into it. So Applied Materials was founded back in 1967 in Santa Clara, California, right in the heart of what would become Silicon Valley. They started out making chemical vapor deposition systems, basically the equipment that deposits thin films onto semiconductor wafers. Fast forward almost 60 years, and they've become the largest semiconductor equipment company in the world by product breadth.
And that breadth is really what sets them apart. Most of their competitors specialize. ASML does lithography, KLA does inspection, Lam does etch. Applied Materials does deposition, etch, process control, metrology, and packaging. They touch more steps in the chip-making process than anyone else.
The business breaks down into 3 segments. Semiconductor Systems is the giant. That's 74% of revenue at nearly $20 billion in fiscal 2025. That's the equipment that goes into fabs. Then you've got Applied Global Services at 23%, about $6.2 billion. That's the maintenance, spare parts, and optimization contracts. And display and adjacent markets rounds it out at about 3%.
The services business is actually a sleeper story here. It grew 8.6% last year, and over 65% of that revenue comes from long-term service agreements. When you have 43,000 tools installed around the world, that's a massive recurring revenue engine.
Their moat is fascinating. 15,000 patents, deeply embedded customer relationships. Once a fab is built around your equipment, the switching costs are astronomical. You don't just swap out a deposition tool mid-production, and they're spending $3.2 billion a year on R&D, which is over 12% of revenue, to stay ahead.
The why now story is all about the 2-nanometer transition. Chip makers are moving to gate-all-around transistor architecture, which requires entirely new materials engineering at the atomic level. Applied just launched 2 new deposition systems specifically for this, the Precision Selective Nitride PE and the Trillium ALD. These aren't incremental upgrades, they're new categories of tools.
Leading the charge is Gary Dickerson, who's been CEO since September 2013, so about 12 and a half years now. His background is interesting. He started in manufacturing and engineering management at GM's Delco Electronics and AT&T Technologies, then spent 18 years at KLA Tencor, rising all the way to Chief Operating Officer.
After KLA, he ran Varian Semiconductor as CEO for 7 years before Applied Materials acquired Varian in 2011. He came over with the deal, became president in 2012, and got the CEO title a year later. Under his watch, revenue has grown from $8 billion to over $28 billion, 3.5 times. He's added 8,500 patents to the portfolio.
Wall Street views him as an R&D-first operator who understands both the technology and the business side. He's navigated semiconductor cycles, managed the China export complexity, and positioned Applied as the essential infrastructure provider for the AI era. Pretty strong track record.
Let's dig into the financials. Applied Materials is trading at $352.62, giving it a market cap of $281 billion. The trailing PE is 36.3, forward PE is about 34, and the price-to-sales ratio sits at 7.66. For context, the 10-year average PE is closer to 18, so the stock is trading at a significant premium to its historical norms.
That's a big premium. What's the market pricing in?
AI-driven structural growth. Trailing 12-month revenue came in at $28.2 billion, with earnings per share at $9.76. The company guided for over 20% growth in their equipment business for calendar 2026, which is aggressive but supported by the data center build-out.
What about the quarterly trend?
Revenue has been steady with a slight upward trajectory. Q2 fiscal 2025 was $6.78 billion, Q3 was 6.95, Q4 was 6.8, and Q1 fiscal 2026 came in at 7.01 billion. Not explosive quarter-over-quarter growth, but consistent. And the guidance for Q 2026 is 7.65 billion, which would be a meaningful step up. Gross margin is 48.7%, and it's been expanding up a full 100 basis points sequentially in Q1. Operating margin is 30%, net margin is 24.7%. These are strong numbers for an equipment company. They're demonstrating real pricing power.
Cash flow picture.
Operating cash flow is nearly 8 billion on a trailing basis. Free cash flow is 5.7 billion. They're sitting on 8.57 billion in cash against 7.05 billion in debt. So they're in a net cash position of about 1.5 billion. Debt to equity is just 0.35. Current ratio is 2.61. The balance sheet is a fortress.
So, profitability, cash generation, and balance sheet all check out.
Overall, Applied Materials' financial health is strong. High margins, consistent cash generation, net cash position, and a conservative capital structure give them significant flexibility heading into what management expects to be an accelerating growth cycle.
So what are the analysts saying?
The consensus is strong buy. Out of 32 analysts covering the stock, 28 rated a buy or strong buy. 4 have holds, 0 sells. The average 12-month price target is 428.84, with a range from 380 on the low end to 470 on the high end. That implies about 22% upside from current levels.
0 sells out of 32 analysts is pretty remarkable.
It reflects broad confidence in the AI equipment cycle. Multiple analysts upgraded the stock in early 2026, specifically citing AI computing acceleration. The consensus price target has been trending higher after the Q1 earnings beat.
Speaking of earnings, how did Q1 shake out?
Fiscal Q1 2026 reported February 12th. Revenue came in at 7.01 billion, which was roughly flat, actually down 2% year over year. But the EPS story was better. Non-GAAP EPS was 238 versus the street's expectation of 221, so a solid beat. They also posted record DRAM revenue and record services and spares revenue.
And the forward guidance?
Q2 revenue guided to 7.65 billion plus or minus 500 million, with non-GAAP EPS of 264 plus or minus 20 cents. The real headline was the full-year call for over 20% growth in the semiconductor equipment business. That's a strong signal from management.
All right, let's lay out both sides. The bull case starts with positioning. Applied Materials sits at the center of the most important technology build-out of our generation. Every AI chip needs to be manufactured, and Applied provides more of the critical equipment steps than anyone. The 2-nanometer GAA transition is a massive upgrade cycle. Chip makers need new tools, period.
Second catalyst is the services flywheel. 43,000 installed tools generating 6+ billion in recurring services revenue, growing at nearly 9%. As the installed base expands with the AI build-out, this becomes an increasingly powerful profit engine with high margins.
Third, they're expanding their addressable market. Advanced packaging for AI chips is a new growth vector. The EPIC Center opening with Samsung as a founding member gives them a collaborative R&D edge. And management is launching 12+ new products this year. They're playing offense.
Now for the bear case. First and foremost is China. U.S. export restrictions are forecast to reduce fiscal 2026 revenue by $600 to $710 million. China has historically been 30 to 45% of their revenue. That's a meaningful headwind, and the regulatory environment could tighten further.
Fair point. What else?
Valuation risk. The stock is trading at 36 times trailing earnings versus a 10-year average of 18. A discounted cash flow analysis suggests you need 24% free cash flow growth to justify the current price. If the AI spending cycle pauses or decelerates, there's significant multiple compression risk.
And the cyclicality concern.
Always present in semiconductor equipment. This industry has boom and bust written into its DNA. Even with structural AI tailwinds, a global recession could cause chip makers to defer multi-billion-dollar fab expansions. And technical challenges at the 2-nanometer node are real. If major customers struggle with yield, tool demand could slip.
Let's put Applied Materials in context against its peers. How does it stack up against Lam Research, KLA, and ASML?
Starting with Lam Research, ticker LRCX, they're trading at about 46 times earnings, with revenue growth of 26%, driven heavily by memory spending. Lam has strong momentum, but higher concentration in the volatile memory market, where about half their revenue comes from. Applied is more diversified. KLA, ticker KLAC, trades at about 42 times earnings with 17.5% revenue growth. They're the inspection and metrology specialist, more focused than Applied, but with consistent execution and a 16-year dividend growth streak. They trade at a higher price-to-sales ratio of almost 15 because the market values their process control dominance.
Then there's the gorilla, ASML.
ASML trades at about 46 times earnings with 31% revenue growth. They have a monopoly on extreme ultraviolet lithography. Nobody else can make those machines. That gives them superior pricing power with 51% gross margins. But they also face China export headwinds, and the monopoly premium means you're paying more per dollar of revenue.
So Applied actually trades at a valuation discount to all three major peers while offering the broadest product portfolio. That's an interesting setup. What's the options market telling us?
The put-call ratio is 0.96, which is slightly below 1. That's a modestly bullish signal. Implied volatility is sitting around the 55th percentile, so moderate expectation of price movement heading into the Q2 earnings report in May. Notable call open interest is clustered around the 370 and 400 strikes, suggesting options traders are positioning for upside. Put protection is concentrated at 320 and 300.
Whale activity?
Recent unusual options activity shows about $1.17 million in call premiums versus just $161,000 in puts. So the big money is leaning bullish, though it's worth noting sentiment was split, about 36% bullish versus 42% bearish among the larger trades. Not a unanimous signal, but the dollar-weighted flow favors the upside.
What about insider activity?
This is worth noting. Over the past 6 months, there have been 0 insider buys and 5 insider sells. CFO Brees Hill sold 5,000 shares worth about $1.8 million in February. Director Judy Bruner sold multiple tranches totaling around $2.5 million. And Controller Adam Sanders sold shares in early April.
No buys at all?
None. Now, consistent selling from executives isn't automatically bearish. These are often pre-planned diversification sales under 10b5-1 plans. But the complete absence of any insider buying alongside elevated valuations is worth flagging. Insiders aren't putting new money to work at these prices.
Let's run through the key risks. China export restrictions are front and center. 600 to 700 million in potential revenue impact this year alone, and the regulatory picture could get worse.
Valuation compression is the second risk. At 36 times earnings, the stock needs flawless execution and continued AI spending acceleration. Any earnings miss or guidance cut could trigger a significant repricing.
Cyclicality is always lurking. Even the best secular stories in this industry have been interrupted by spending pauses.
Key metrics to watch going forward: Q2 revenue versus the $7.65 billion guide, gross margin trajectory, they need to hold that 49% non-GAAP level, and any updates on China revenue impact. The next catalyst is the Q2 earnings report on May 14th.
All right, let's bring it all together.
Applied Materials is the broadest, most diversified play on the semiconductor equipment supercycle. They're essential infrastructure for the AI build-out, with a product portfolio that touches more fabrication steps than any competitor. The financials are strong. Net cash, 30% operating margins, nearly $8 billion in operating cash flow. The street loves it with 28 of 32 analysts at buy and 0 sells.
But it's not without wrinkles.
No. China headwinds are real and quantifiable. The valuation is stretched versus history, and insiders are selling, not buying. The single most important metric to watch is whether management delivers on that 20+% equipment growth guidance for calendar 2026. If they do, the valuation can be sustained. If they don't, there's a lot of air underneath.
CEO Gary Dickerson said it best on the last earnings call, and I'm paraphrasing here. that Applied Materials results were fueled by the acceleration of industry investments in AI computing, with the fastest-growing markets being leading-edge logic, high-bandwidth memory, and advanced packaging. That's the thesis in one sentence.
It is. They're not just riding the AI wave, they're the infrastructure that makes it possible.
That's going to do it for episode 84 of Charged Alpha, our deep dive into Applied Materials, ticker AMAT. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.